Do you love getting a surprise tax bill in April? No, no one loves that. And today we are covering the importance of using strategic tax planning and moving away from last minute panic towards predictable cash flow, optimized deductions, and real peace of mind. As we say at All Accounting, when you know your numbers, you own your future. So let's get into how to proactively take strategy, keep money where it belongs in your business. All right. So when you have a business, when you start your business, we kind of just go all in right away and we forget all of this administration things. And one of the biggest things that you can think about on a regular basis to help you with your expenses is your tax bill. We do not like to think of the silent partner, the IRS, as someone within our business, but they do take a hefty portion of our profits. And there are lots and lots of regulations and tax code to help you guide and take deductions that you as a business owner should be taking to eliminate that tax bill. What is the difference between tax planning and strategy versus compliance? So most of us, most business owners are really known for tax compliance. Do you file your taxes on time with the IRS, or do you get the extension and make sure that you file in time? Do you make your estimated payments? Do you do all of the things that are required up front to at least get the IRS off your back? You don't have a failure to file penalty, and all of those annual deadlines are met. That is what tax compliance is, and what a lot of accounting firms do for you. Think of it like the Department of Revenue or the California Department of Tax, where you have to file your sales tax. Same thing with your federal or state taxes. But with tax strategy and tax planning, we can really look at forward ideas and plan how we want to either expense things through the business that are deductible, leverage lawful tax credits, maximize and keep money in your business. Really, it's unlocking cash flow and growth. And one of the best things that you can do first is just ensure that you have a predictable working capital. This is going to eliminate the surprises in April and having these hefty tax bills and making sure your estimated payments are going along. But making a 13-week cash flow is going to help you ensure that money is there all of the time, so that it's not just like, oh my gosh, this big thing is hitting my account again. And then when we are looking at on a regular basis, we can actually reduce tax liabilities and help fund purchases, perhaps. If at the end of the year we're looking and seeing that we may have a larger tax bill, what we can do is perhaps utilize equipment purchases to offset with deductions, with depreciation, and you can insert that back into your business while keeping hold of the cash. And then really just ensuring that you're evening out everything. Is there a project that you're potentially looking at starting? Maybe you want to push that off a couple months so that you don't have any revenue with no expenses against it. And it's really just making sure that you are clean and compliant with your books all year long so that you can really plan and look at what your tax bill might be. Some pillars to look at when you are proactive tax planning is going to be looking at how your entity is structured. Are you a sole prop? Are you an LLC? These items you pay all taxes on all net income are self-employed taxes. But when you become an S Corp or a C Corp, you're then allowed to utilize yourself as an employee, and then you get some tax deductions. In all of this, you are never getting away from taxes, but it's shifting taxes from here to there in lower tax brackets in order to pay a lesser amount. So that's really the goal in all of this tax planning and tax strategy, is shifting from here and there where your deductions can land, where your income is going to land, so that you can pay the least amount of taxes. The deduction strategy is a great pillar. Like I previously mentioned, this is going to be asset purchases, so that you can do bonus depreciation on vehicles, or perhaps you're getting a big fencing equipment, or anything that you can think of to reinvest into your business. Do you have a home office? That's allowed. Do you have health insurance that you're purchasing for yourself and employees? Just really looking and seeing what might be available for your specific business. And then income timing. This is really ensuring that, are you on a cash or an accrual basis on your taxes? What's the most benefit for you? Now, you can't switch from one year to the other, but you might have hit an income threshold, that you do want to, in fact, start using accrual basis, and you've been using cash basis. So the best timing for that, so that you can take advantage of some tax savings. Going back to that entity structure and the self-employment taxes, this is one of the greater ideas, is going from an LLC to an S Corp. It's a generalization, but between $50,000 and $80,000 of net income is when you start to go into that tipping point of wanting to look at, should I in fact, move into an S Corp? There are some other nuances with that even if you are at that net income, you may not want to go into an S Corp, but it's something to definitely look at and make sure that it would benefit you or not. And then this is kind of our cadence where we look at the milestones throughout the year for tax planning, because it's not just a one and done like we do with tax compliance, where we basically are writing everything in and, okay, whatever happens, and this is what it is. So in quarter one, we're really just kind of seeing where last year landed, finalizing budgets, kind of estimating, is last year and this year going to be very similar to last year, or is it going to change? Just making sure that we're hitting those estimated tax benchmarks. And then in the mid-year, so quarter two, we're just ensuring that we're making the payments necessary. And then we're also reviewing any payroll benefits and balances to ensure that we are capturing all that needs to with your payroll. And then quarter three is where it really ramps up, because we get a better idea of where your company is, and we can see, are there equipment leases or any CapEx and equipment planning that maybe need to be thought about now, so that we can take advantage of those tax benefits. And then at quarter four, year end, we're basically seeing, are there any retirement accounts that we want to take advantage of? Is there perhaps accelerated deductible expenses, and potentially deferring that income? And then all accounting. When you come on with us, What we do first is we make sure to look at your books and do a financial diagnostic. So this is actually going to just see where are you in the process. Do you have clean books? Do you not have clean books? Ensuring that everything is up to date and that we are compliant with all agencies, whether that's state or federal, and ensuring that at least we are good standing with everyone. And then this is where strategy can come into play and really look at the tax strategy for your 13-week forecast and ensuring are there deductibles that you can um, look into for your business. And then after that, then we have a monthly cadence with our clients with a virtual CFO. And so this is going to be analyzing all your numbers on a regular basis, tracking certain KPIs to make sure that you're hitting your numbers or not hitting your numbers, where are there leakage, and then just proactively looking and ensuring, is there anything that we can maybe capture on your tax return to help offset tax planning or the tax bill in April? We really believe that when you know your numbers, you can own your future. And it's really the strategic guidance isn't about filing taxes. It's about really building long-term clarity and wealth. So, yeah, I hope that you enjoyed this today. If you did, please like and subscribe to our channel and tune in next week. We will see you soon.